Hello again. One quick note about closing the accounts when you have perpetual or periodic inventory system. So let's look again at the notes. So as I mentioned, you do all the journal entries and then prepare the ledgers. So in the ledger for merchandise inventory you have 4,000, and in the cost of goods sold ledger you have 7,808. Then you prepare the unadjusted trial balance and then make adjustment for the shrinkage. So here we decide to debit cost of goods sold against merchandise inventory credit, and as a result cost of goods sold becomes 2,000 bigger, 9,808, and merchandise inventory becomes 2,000 smaller. Alternatively, if the shrinkage is large, you can use merchandise inventory account, so it will become smaller, and debit inventory loss, that would be another account, not cost of goods sold. So that's pretty easy for the perpetual inventory system. Then you prepare the adjusted trial balance and put and prepare the income statement with COGS and with the sales and various contra revenue accounts here, and then you prepare the balance sheet with the merchandise inventory, and then prepare income summary and transfer the income of 2034 into the retained earnings. So the closing entries would be as usual as for any other type of business. So normal balance for sales is revenue. When we close sales, we debit sales. And the expenses, the normal balance is debit. When we close expenses, then we will credit. And the respective entries for the income summary. Yeah, like that. So sales debit, credit, income summary. All sorts of costs will be credited, debit, income summary. Then you compare these two values, and you will the difference here would be 2034. That would be the profit. Yeah, it would be transferred like that from income summary to retained earnings, and the shrinkage is the adjusting entry that makes balance smaller, 4,000 to 2,000, and here bigger, from 7,808 to 9,808. With regard to periodic system, there will be the inventory account will not be affected during the year, although it may have some positive balance in the beginning. Just during the year you don't touch this account. So let's scroll down, and you prepare the relevant journal entries and unadjusted trial balance. In merchandise inventory there will be 0, and of course there will be no cost of goods sold account. It's not here, and then you will need to determine the cost of goods sold. So you will have opening inventory. In our case is 0, doesn't have to be, can be something else here. Then you will add purchases and other expenses, and less purchase returns and discounts, and you will get cost of goods available for sale. Then at the last day, at the end of the accounting period, we will count inventory and determine that it is equal to something. In our case, similar to perpetual system, it's 2,000. So we know ending inventory, and knowing cost of goods available for sale and ending inventory, we can find cost of goods sold. And then it can be subtracted from net sales, and you can find gross profit and net income in the income statement. And of course it can be transferred to the retained earnings statement, and you can find retained earnings. And of course the balance sheet can be prepared. There will be ending inventory going there. But one more thing, we need to make, when we make closing inventories, everything will be same as in perpetual system. So sales, normal balance is credit, they will be debited against income summary. And all various expenses, their balance is debit, they will be credited against income summary, and the difference would be found, of course, between two sides of the income summary account, and the difference will give you, for example, here this one side of the income summary and the other side of the income summary. So the difference here will give you 2034. That will be your net income that will go to retained earnings. However, there will be one more entry here, or you need to put a merchandise inventory ending and merchandise inventory opening, and you must do that, because if you do not do this, suppose we do not put anything here or anything here, then obviously these two figures would be different. And for example, if we do not put 2000 here, then the value here would be 12,317, whereas here it is 12,283, and the difference between them will give you profit, but not 2034, but only 66. If we have here 12,317 and this figure here, the difference is only 66, which is of course not correct, because we found that COGS is equal to the different value, right? So you will not be, and the profit will be different. Of course, we found the profit is 2034. So if you do not put these two values here, you will get wrong numbers for the profit. And vice versa, if for example here you do not put the for example, here you do not put opening inventory, but here you put ending inventory, again, the values would be different. So you must put ending inventory here and opening inventory here when you're closing accounts. In all other respects, everything will be same. Sales and contra expense accounts here, and expenses and contra revenue accounts here. Thank you.